Working capital represents a company's ability to pay its current liabilities with its current assets. Working capital is an important measure of financial health since creditors can measure a company's ability to pay off its debts within a year. Working capital represents the difference between a firm's current assets and current liabilities. The challenge can be determining the proper category for the vast array of assets and liabilities on a corporate balance sheet and deciphering the overall health of a firm in meeting its short-term commitments. Working capital, also known as net working capital (NWC), is the difference between a company's current assets, such as cash, accounts receivable, customers' unpaid bills, and inventories of raw materials and finished goods, and its current liabilities, such as accounts payable. Net operating working capital is a measure of a company's liquidity and refers to the difference between operating current assets and operating current liabilities. In many cases, these calculations are the same and are derived from company cash plus accounts receivable plus inventories, fewer accounts payable and less accrued expenses. Working capital is a measure of a company's liquidity, operational efficiency, and its short-term financial health. If a company has substantial positive working capital, then it should have the potential to invest and grow. If a company's current assets do not exceed its current liabilities, then it may have trouble growing or paying back creditors, or even go bankrupt. Components of working capital. 1. Current assets. This is what a company currently owns, both tangible and intangible, that it can easily turn into cash within 1 year or one business cycle, whichever is less. More obvious categories include checking and savings accounts, highly liquid marketable securities such as stocks, bonds, mutual funds, and ETFs, money market accounts, cash and cash equivalents, accounts receivable, inventory, and other shorter-term prepaid expenses. Other examples include current assets of discontinued operations and interest payable. Current assets do not include long-term or illiquid investments such as certain hedge funds, real estate, or collectibles. 2. Current liabilities. In a similar fashion, current liabilities include all the debts and expenses the firm expects to pay within a year or one business cycle, whichever is less. This typically includes all the normal costs of running the business such as rent, utilities, materials and supplies, interest or principal payments on debt, accounts payable, accrued liabilities, and accrued income taxes. Other current liabilities include dividends payable, capital leases due within a year, and long-term debt that is now coming due. Changes in working capital affect a company's cash flow. Most major new projects, such as an expansion in production or into new markets, require an investment in working capital. That reduces cash flow. But cash will also fall if money is collected too slowly, or if sales volumes are decreasing, which will lead to a fall in accounts receivable. Companies that are using working capital inefficiently can boost cash flow by squeezing suppliers and customers.